Thanks for clicking. My name is Mark Mitchell. I'm a mortgage broker here in London, Ontario. We had a big week this week in China's real estate crisis as Evergrande had some of its properties seized forcefully by Western investors.
Oh my God, are they all right?
And then China's real estate prices plunged even further. And then we received even more news on the state of China's local government's hidden debt, which is looking more and more to be very Bernie Madoff-esque.
So it's a Ponzi scheme within a Ponzi scheme.
So what I want to do today is briefly go over Evergrande, as the situation is definitely heating up between the real estate developer and its Western investors. Then I want to go over China's real estate data, not only because it's continuing to worsen, but it's also bleeding into our last topic, which will be local government finance vehicles, LGFVs, which are starting to look more and more like a Ponzi scheme, and definitely making it appear as though we have a deepening debt crisis in China. We will continue to have updates on China every Friday as this crisis continues on. Click like and subscribe if you want to get those updates, but for now, let's get into Evergrande. On to Evergrande. It was announced last week that Chinese authorities were considering breaking up Evergrande into multiple smaller parts.
We're family!
Under the proposal, Evergrande would sell off the majority of its real estate assets, save for its EV division and its property management division.
Essentially looking to sort of dismantle the firm, sell the bulk of its assets, and then Cinder, a group led by Cinder, which is one of China's state-run bad debt managers, would take on anything that wasn't left.
So basically, China would force Evergrande to sell off everything that's profitable, and then the state would buy everything that was not, sort of putting a tarp around Evergrande's troubled assets.
There's not going to be a Lehman moment.
Evergrande also had two properties seized this week by Oaktree, a U.S. investment firm, one in Wenlong and the other in Shanghai, as the U.S.-based firm sought to recoup over $1 billion in loans. So, despite the spat that we talked about last week between Evergrande and Western investors, where Western investors threatened legal action against the real estate developer and Evergrande responded that such action would be destructive, Western investors don't seem to be responding very well, forcibly seizing Evergrande's assets. If this is a sign of things to come, as we're set to see a lot more developers continue to default on their loans, and Western investors are getting more and more concerned about losing money in China, we could be in for a very tumultuous 2022.
Now, we have seen these signs of rising tensions between the offshore creditors, in particular, the ad hoc bondholder committee, and Evergrande itself.
In fact, it's already looking more and more like we're in for a very tumultuous 2022. Despite the People's Bank of China's efforts to re-stimulate the economy to make it much more attractive for borrowers to buy homes in China, Chinese real estate continued to slide in January. Home sales plunged 39.6% in January, worsening from their 35.2% in December. So the situation's definitely not getting better in China's real estate market. Homes are down even more. And this is not only a bad sign for the Chinese real estate market, for the PBOC's efforts to re-stimulate the market, and for China's overall economy. It's also bad for government revenue.
If it goes bad for me, it's going to go bad for a lot of people.
Yeah.
As we've talked about before, a large portion of Chinese government's revenue comes from the sale of land. So it also came out this week that growth in government revenue from property sales fell to 3.8% compared to 15.9% in 2022 and 11.4% in 2019, which is just a massive drop in the amount of money being received by these local governments at a time when these governments need it the most.
There's no money.
Speaking of money needed by the government, we've talked about local government finance vehicles before on this channel, which are basically a means of Chinese governments borrowing money off the books. So they don't show up on official balance sheets, but these LGFVs, these local government finance vehicles, are implicitly backed, they are implicitly guaranteed by these local governments. These LGFVs typically involve investment firms selling bonds in order to finance real estate development or other local infrastructure projects. The problem, though, with these LGFVs really came to light this week when there was a land sale in the city of Rizhao. Under this land sale, there were 4 bids worth $170 million, but upon closer inspection, it was revealed that those 4 bids for that $170 million were submitted by an LGFV backed by the Rizhao government. So, the Rizhao government in China effectively put in bids through their LGFV to buy real estate from themselves, which is basically like using your credit card to buy goods from your small business and then claiming a profit on that business. You're just using debt to finance your growth, and not in the productive way. It's non-existent. You're just moving money around in a circle. If this seems problematic, it's because it is. This is basically a Ponzi scheme, as it requires more and more new investors to lend money to these LGFVs, which buy money from the government, and then the government provides the money to these LGFVs to pay off the investors. The problem with moving money around like this is that it requires constantly new investors coming into the system, which is very, as we said at the beginning, Bernie Madoff-esque.
Flim flam, Ponzi scheme, pyramid, straw man.
And the situation with these LGFVs is not getting any better. As we've mentioned previously on this channel, that Goldman Sachs uncovered in late 2021 that there was about $8 trillion in LGFV debt throughout China. $8 trillion is about half of Chinese GDP. And according to one expert, LGFVs are actually now accounting for about half of state sales in China. So we have a continual worsening government finance crisis, which is fueling a debt crisis, which is actually skewing the true state of the real estate numbers throughout China. All in all, not a great situation. The one saving grace that we do have is that Beijing is fairly well funded, although it's not clear that they want to print $8 trillion to bail out these failing entities, these failing governments, these failing businesses.
Hey, that's our thing.
But stranger things have happened. Nobody really envisioned the U.S. government bailing out all of the Wall Street firms, all of the big banks in 2008, and that's exactly what they did. So one way or another, Beijing is going to have to continue to get its hands wrapped around this, and there's not a lot of evidence that they're doing an effective job. Yes, getting its arms around Evergrande and letting people know that they are going to be taking control was great, but it looks like they have come a little bit late to the party, as Western investors are moving in very fast to seize property, to get their money back. When the sheriff has to come to your door to seize your house, you're a little late to the party to make that final mortgage payment. And I mean, all signs are pointing to the fact that we have a worsening real estate crisis, economic crisis, and debt crisis in China. Not to mention, we haven't even talked about the lockdowns and their zero COVID policy and how well that's working, which it doesn't look like it's working that great right now, but it's really not the focus of this channel. So things are not great for China right now. And as we talked about before, with China holding such a large percentage of the world GDP, when they sneeze, we will feel it. So, as things continue to worsen in China, expect prices there to go up, which will make prices up here go up, prices in the West, in the US, in Canada go up, which will put more pressure on our central banks to raise interest rates. But we will continue to cover this real estate crisis. We might start calling it a debt crisis as this continues. But we will continue to cover it every Friday. Click like and subscribe if you want to get those updates. And thanks so much for watching.